Intel just reported earnings. The stock is down 11% in the after hours. Absolutely insane. The stock is still up 37% year to date. It had a massive run. But they did put up a massive beat on earnings per share, 15 cents versus 8 cents expected. They also beat on revenues, which was really amazing. But in terms of guidance, the guidance was really bad. They put up break even in terms of earnings per share, and the analysts, they were expecting 5 cents in earnings per share. This is a massive miss for a company like Intel. Looking at the total numbers, revenues were still down 4.1% year on year, still above their outlook. Gross margins were also down, which was above their outlook. And the quarter wasn't really bad in general, but in terms of guidance, it was a little bit below the expectations. In terms of their computer chips, they declined quarter on quarter, and they've been lagging behind the AMD and other players in their computer chips. Their AI chips have been taking off, and they re-accelerated in their AI chips revenues, which is really nice to see, with an expansion in operating margins from 23% to 26%, up to from 16 and 13 and 8%. So this is a massive improvement, and that's becoming a bigger part of Intel, and that's really amazing for the company. The foundry is still a money-losing business with negative 55% operating margins. It's losing about $2.5 billion in operating income, and I'm sure most of you guys are not surprised to see those numbers. You didn't invest in Intel for the buybacks or the dividend or because the company is profitable. You invested in Intel for national security concerns. That's why people own the stock. They're willing to wait a year, 2 years, 3 years for the company to scale the foundries. And at the end of the day, it's a national security stock with most of those chips being made in Taiwan, especially the AI-related chips. Most of them are made in Taiwan, and they're trying to bring them to the United States. And that's a big trend, and a lot of those stocks are taking off. One of them is Intel, even though it has terrible financials, but the market is front-running the potential improvement. Now, this improvement didn't come, and that's why Intel is down 11% so far in the after hours. Intel sold $5 billion of its stock to NVIDIA to raise money for them to be able to pay for the capex required to be able to scale the foundry business, which has pretty much skyrocketed shares outstanding, and it has really diluted shareholders, and shareholders have yet to see a return on this investment. It's going to be a money-losing business for the next at least 2 to 3 years, at least on a free cash flow basis. But now their balance sheet is better than ever. They have about $46 billion in total cash and cash equivalent and long-term investments. For their debt, they have $44 billion in long-term debt and about $2.5 billion in short-term debt. So it's pretty much equal in terms of cash and their long-term debt, and they can satisfy the obligations, and they can also scale the foundry. So they should not dilute any more stock. I don't think they will. I think they have enough cash for them to be able to satisfy their obligations and scale the foundry going forward. Now, if we look at the PE ratio, Intel is still trading at 126 times earnings, and it may look like it's extremely overvalued, but the company is just turning profitable. So this is 126 times depressed earnings with like 1 or 2% net income margins, and their earnings per share is expected to skyrocket from negative 6 cents to positive 61 cents, to positive $1.09, up to $1.97 in 2028. And this is very possible as the company is just starting to expand its net income margin from 0% to 3%, 5%. You normally see a massive increase in earnings per share. So I think this is very possible. Now, for my valuation model for 2030 or over the next 5 years, I used $1.97 for 2028, which is expected by the analyst, and I'm assuming Intel is gonna hit this number. Hopefully, I put in $1.97 for 2 years, so from 2028 to 2030, it would be a total of 5 years, you could say, with an estimated interest rate or estimated growth of 20% earnings per share for 2029-2030. I believe this is fair. In total, I got $2.84 in earnings per share for 2030. I take the 284 and I time it by 25 times earnings, I think 25 times is a little bit high. Even if you compare it to Taiwan Semi, I think it's high. But I'm assuming the best case scenario to try to make a point in this video. And I'm going to time it by 25 times earnings, which I believe would be expensive. This is $71 per share for 2030 on Intel. If I'm trying to get it double on Intel over the next 5 years, I have to pay no more than $35.50 for Intel. And Intel right now, even after the 11% drop, is trading at $48 per share. So I personally believe Intel is somewhat of an overvalued stock. I think the easy money has been made. Maybe the stock can keep going up due to the national security trend and funds are buying it and everyone's buying it. But for me personally, the valuation doesn't make any sense. I valued it on the best case scenario using 25 times earnings, unless it trades at 50 times earnings, and it's not going to have the best profit margins ever operating in the United States. So I highly doubt it's going to trade at 50 times. But at 25 times, I'm not seeing it double. If I want to get it double, I have to buy it at $35, and now it's trading at $48 per share. So for me, I'm putting a price alert at 35. If it gets there, then I start getting interested in the company. And that's my opinion on Intel. It was not financial advice. Hope you enjoyed it. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.